On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Last week's cut to the official cash rate, the OCR, received an awful lot of attention, and rightly so. It was the first cut since 2020, and it marked the end of 15 months at 5.5%, which is the highest we'd seen since 2008. Now, that sparked the biggest two-day rally in New Zealand shares that we'd seen for over 2 years. And the beginning of the easing cycle is why the share market has bounced more than 10% from its recent lows of 2 or 3 months ago. So is that optimism justified? Will it last? And what's happened to share markets in the past following interest rate cuts? I looked back at all the times the OCR has reached a peak in the last 25 years, since 1999, which is when it actually came into existence in its current form. And then I looked at how shares and bonds, or fixed income, performed in the period after that first cut. So there's been 5 easing cycles since the turn of the century, 5 over the last 25 years. And an easing cycle is when you sort of get to the top of the hill in terms of central bank policy rates, the OCR, and then you start coming down again. So when interest rates are going up, when the central bank is raising the OCR, you call that a tightening cycle. They're making monetary policy and monetary conditions tighter. And when they're reducing interest rates, when they start coming down the other side of the hill, that is an easing cycle. They're loosening monetary policy and financial conditions. So easing cycles are when rates start coming down. 5 of those since 1999, and they all started in 2001, 2003, 2008, 2011, and 2015. Now, you might think I'm forgetting about one important one, which was during the COVID era, which is when interest rates came down quite aggressively, and we also had quantitative easing, money printing, asset purchases, whatever you want to call it. However, that was really a continuation of an easing cycle that was already underway, because the OCR reached a peak of 3.5% in 2014 and 2015, and it had already fallen steadily to 1% by the time the lockdowns ensured that we fell into recession in 2020. So interest rates obviously fell even further at that point, but it wasn't the start of a decline from a recent peak. It was really just a continuation of what was already happening, and that COVID period made that happen much more quickly and much more aggressively. So that's why it's not in the numbers. That's the way I've defined an easing cycle. It's got to be after a recent peak. So anyway, what did the analysis tell me about what share markets, New Zealand shares at least, have done following an OCR cut? Well, in those 5 examples, in the first 6 months following that initial OCR cut after the peak, share market returns were a bit of a mixed bag. But things do become a little bit clearer if you look beyond that, I'll call it a dust settling period, over that first 3 months, 6 months. And if you look out over the first 12 months after the first OCR cut, the market has been up on 4 out of 5 occasions. And the average return across all 5 of those, including the one when it was down, the average return was 12.2%, which is not bad at all over a 12-month period, certainly a little above the long-term average. That's total return, by the way, so it's share price changes and dividend income, cash dividends, not imputation credits. Now, in the first 24 months following an OCR cut, the market was also up 4 out of 5 times, and the average return, total return over those 5 examples was 25%, or just under 25%, so not bad at all. Very healthy returns and a very solid 80% hit rate, 4 out of 5, with the odd one out being the easing cycle that started in July 2008. Now, what was different about July 2008? Many of you will remember that by then the economy was already in a pretty severe recession. That was the GFC. So the recession that we've been in at the moment doesn't even compare to what we saw back in the GFC. But in 2008, things were really, really difficult and really shaky. So at that point, even though interest rates started coming down, any optimism because of that was well and truly drowned out by a very, very difficult period for businesses and households. Now, it's not dissimilar when you look at the history of easing cycles in the United States, the US. Since 1980, there have been 10 times when the Federal Reserve, the Fed, that's the US central bank, our equivalent of the Reserve Bank here in New Zealand, 10 times since 1980 when the Fed has started cutting interest rates from a peak. The S&P 500, which is the main US share market index, it was up 7 times in the 12 months after that first cut. So 7 out of 10 times, not bad for an average gain of 7.8%. And in the 2 years afterwards, when we look out 24 months after that first cut rather than 12, you've got 8 times where the US share market was up. So 80% of the time, not too bad for an average return of 24.1%, which again, not too bad at all over a 2-year period. So the only easing cycles that weren't accompanied by positive returns over 12 months or 24 months were 3: 1981, 2001, and 2007. And it's very similar to New Zealand, isn't it? As was the case here, those 3 examples were all around the time of recessions. 1981, that was when the US economy was in recession. Interest rates were going up a lot. They'd had very high inflation in the 1970s, and interest rates had to go up so dramatically that they basically needed to engineer a deep recession, make unemployment go up a lot to get that inflation under control. So it was a pretty ugly period. It was just when Ronald Reagan was coming into office and they were entering or about to enter that quite buoyant period of the 1980s, but they were coming off the back of that very difficult period in the 1970s. So a bit of a history lesson there. 2001, in more recent memory, that's around the time of the dot-com bubble. That wasn't such a big deal here in New Zealand because we didn't have really any dot-com internet stocks on our share market, so there was no bubble to burst. So our share market just sailed through that without any real fanfare or without any real decline, and we didn't have a recession. But the US had a severe recession. The US share market was cut in half because of the bursting of that dot-com bubble and all of those internet stocks that didn't really generate any profits, and it was more hype than substance. So that contributed to a US recession in the early 2000s. And that was one of the reasons that the market performed so badly, because there was a recession that went hand in hand with that easing cycle. And then 2007, same as here, it was the GFC. So no amount of interest rate cuts were going to save us from what was happening at the time. So what does that tell us here in New Zealand, in the United States? Every time we've seen interest rates reach a peak and then start coming down, that has proved to be a very good period for the share market in both countries. The only times when we haven't seen good returns has been when we've had a recession in either of those 2 countries. The case is a lot clearer for bonds and fixed income in every easing cycle since the OCR came into being in 1999. So that's those 25 years, same period as I looked for with the New Zealand share market. The NZX Government Bond Index has delivered positive returns in the 6 months, 12 months, and 24 months following that first cut. So that's again total return. It's the income that those bonds have generated plus any movement in price. So those are the 2 ways you get returns, and I've put them all together. It's what we call a total return. It's what investors should be more focused on than just looking at income or just looking at changes in capital value. But 100% hit rate. That makes sense, doesn't it? Bonds and fixed income should do well when interest rates are falling, even if there's a recession. In fact, sometimes they do even better when there's a recession because people flock to those safer, more conservative assets, and those prices can rise even more. So investors benefit from the stable, predictable income they receive from bonds, and they also often see capital growth because existing vintages of bonds, so those that were issued when interest rates were a little bit higher, 3 months ago, 6 months, a year ago, they are repriced higher. So it's much clearer with bonds and fixed income that you tend to do very well in the wake of an easing cycle. So where are we at today? The Reserve Bank has got off the mark. To use a cricket analogy, it's commenced its easing cycle, and that OCR cut from last week was the first of many. And we will head towards 3% or wherever the neutral rate is. Call it the high twos, call it about 3. That's another podcast episode altogether to debate where the neutral rate is. But I think it's fair for us to assume that it sort of maybe bottoms out around 3% over the next couple of years. So there are several more cuts to come. There's quite a big difference between 5.25, where we're at today, and 3%, where we'll probably end up. Similar story in the US. We're likely to see the US Federal Reserve's first interest rate cut next month too. Markets see that as pretty much a done deal. They are at 5.5%. They actually do a range. So the Fed has a range. The top of that range is 5.5%. And I would expect to see a 25 basis point cut, which would mean the top of their range moves down to 5.25, same as us. This should make for a much more attractive investment backdrop for people. Nothing is a sure thing when it comes to investing, although history would suggest that bonds and fixed income will do well over the upcoming period. In fact, we haven't seen any easing cycle in the last 45 odd years in the US and in the last 25 here in New Zealand. The whole time the OCR has been in existence in its current form, we've never seen a time where bonds and fixed income have not given positive returns in the wake of an easing cycle. So that isn't too bad in terms of the historic precedent. When it comes to shares, and the same would go for property. I haven't mentioned property, but I did look at the same figures in terms of New Zealand house prices, what they've done every time we've seen one of those easing cycles. And it looks very similar to shares. You know, your returns are kind of in that 70 or 80% range for positive returns, not quite as high as the share market returns have been, but still house prices do tend to respond very well to falling interest rates. One word of caution is that every period is different and the backdrop is always different whenever any easing cycle starts. So at the moment, when you look at the housing market, I do think we need to be mindful of the fact that prices are quite high in terms of the starting point. Like at the moment, the housing market is not cheap. You know, it did come down from those extreme highs from 2021. You know, it fell quite a bit from late 2021 through to the middle of last year, and then it's been sort of bouncing along the bottom. But the housing market is still much, much more expensive than it was pre-COVID because it just went up so dramatically during that COVID period. It was up almost 50% in 2 years. So many would argue that even though we've seen prices come down over the last 2 years, they've gone from being extremely overvalued to just moderately overvalued. And you've still got a market that is far from affordable, and returns in terms of rental yields and so forth, especially after costs, they don't look fantastic compared to what you've typically seen through history. So I don't want anyone to go away super excited that the housing market is going to fly over the next 2 years. I do think there is a more positive backdrop for the housing market, but remember that your starting point is one of high prices, low affordability, and the gains might be a little more modest and a little more subdued than we've seen during previous easing cycles for the New Zealand housing market. So with that health warning out there, where was I? Yeah, fixed income usually does very well during those easing cycles when it comes to shares and housing. Whether we see that usual period of strong post-rate cut returns, whether we see that from here, it probably hinges on how economic growth develops. In New Zealand, we've been in a mild but difficult recession for the past 18 months. You know, I say mild because it's not as bad as the GFC or other really severe ones like that, but it has been a very difficult one. It sort of felt like this long drawn out death by 1,000 cuts sort of recession. I feel like we've taken a bit of our medicine there, so hopefully that puts us in a reasonable position. I am feeling confident and optimistic about the New Zealand share market over this next little while. We're still well down from those peaks from early 2021, especially when you exclude dividend returns. You know, we're still down quite a bit from those levels, double digit. The US, different kettle of fish. They haven't had a recession. They've been very strong over this 2 or 3 year period. And that's a good thing because they are in a stable position, but there are still some commentators out there who believe that a slowdown of some magnitude might be around the corner. And you never know, we'll have to wait and see. But I think for today, key messages are that easing cycles tend to be very friendly for investors. They typically do lead to good returns from bonds and fixed income almost always. So that is not a sure thing, but nothing ever is. But I would say your prospects for stable, steady, positive returns are high. When it comes to shares, when it comes to housing, it will come down to whether the economy holds together and whether central banks have cut rates early enough to avoid a lengthy period of economic recession or uncertainty. So hopefully we've got there. Hopefully it is a soft landing that is around the corner rather than a hard landing. If you want to know more, if you want to talk about any of that and what it means for your individual situation, your portfolio, how to benefit from the interest rate cuts that we're likely to see continue this year and into next year and into the following year, give us a call, talk to your advisor, lots of information. All right, that's all for today. Thanks for listening.
For more insights, visit craigsip.com.